Hope everyone's enjoying the 2 days so far in the Boss Up event. It's been a significant amount of work for Nunzio and his team, and I'm happy to be here and happy to be involved. It's much appreciated. But I'm looking forward to walking people through this session on how to attract and sell to a strategic buyer. I dive in, I start high level and then I dive in pretty deep. So buckle up. We've got 45 minutes to do it, but that'll be ample time, and you'll leave with a good understanding of what you need to do with your company if you're looking to sell to a competitor or larger company that's going to acquire you, or a private equity firm, or anybody who can strategically acquire your business and pay a little bit more of a premium on it. Hi, Roxanne. All right. Well, I'm happy enough to start rolling. I'll give you a little bit of background on myself. So I live in Revelstoke, British Columbia. So for those of you that are skiers or heli skiers, you probably know this place. If not, there's no reason to know it. It's like a bumpkin town in the middle of interior British Columbia in Canada. I grew up outside of Toronto, so that's Nunzio's neck of the woods. I grew up in Mississauga, but 12 years ago, I moved out here to be a ski bum, basically. I sell companies day to day, but last night we got 16 centimeters of snow. So after the presentation today, and after the event's over, I'm going to be going out and doing a couple laps because we still have some daylight here because it's only 12 o'clock here in BC. Okay, so other background, I've had 11 companies myself. I've sold 3 of them. Some of them I just shut down, which is the nature of the beast. I think when you're a business owner, this happens. And part of my presentation is how to avoid that. But I've sold to private equity. I've transferred to my staff. I've transferred to a board of directors, different exit options, transferred to an individual buyer. So these are things I've personally done. But for over the last 10 years, I've been selling companies. So that's what we do. My company is called Open Road, and we're a team of 7, and we primarily operate in the $2 to $20 million revenue range. I'm going to show you kind of where that breaks down in this presentation of what size your business needs to be to attract a different kind of buyer. So I'm going to share my screen and then get started here on the presentation. Okay, this is where we're at today, selling to a strategic buyer. And the presentation today, I give a bit of an introductory of myself. I talk about the different transfer methods first, so you get an understanding of the different ways that you can exit out of your business. I give a high level on the M&A landscape, and then I talk a little bit about valuation, which is kind of critical information to know to understand how business is going to be valued, and also how it's going to be valued by a strategic buyer. I'll go through some industry data and show you where you can get that information if you're looking to get an idea of what multiple your business is going to trade at. And I talk a tiny bit of increasing cash at close and touch a little bit on due diligence. I may go off script a little bit on this one because we are trying to focus primarily on selling to a strategic. So I might deviate a little bit, but for the most part, this is going to be over the next 45 minutes what I'm going to be going through. My primary objective here is just to give you guys the information you need to know to maximize the value of your business before you sell. So that's kind of the underlying tone here. Selling to a strategic is definitely how you maximize your sale price. So that's why it's leaning that way, this presentation. But in general, depending on who you can sell to. Okay, let me dive into it because I'm going to show you here the different transfer methods. So this slide here comes from the EPI, which is the Exit Plan Institute. And so they do a survey every single year asking business owners how they think or anticipate that they're going to sell their business when they're looking at a transition. And so this is not what happens in the real world, but it's how people think they're going to transition their company. So you look at some 21% of people are going to transfer to family if they have that option, if there's family working within the business. And management buyout, so they'll transfer their management. Internally transfer to partnerships, those other shareholders, which is actually kind of interesting because this is a smaller sliver than I would have anticipated. Internally transfer to their employees. So this is an option that you actually have once your company you need to have some employees obviously to transfer to them, but you can put together an employee share option plan and then transfer your entire company to your employees. I don't talk to that much in this presentation. It's a slower option for transitioning, but it's a guaranteed because your employees are there and they're can be potential buyers. This is what I talk about most in this presentation, which is transferring externally to a third-party strategic buyer, private equity. 29% of people think they're going to be selling their businesses this way to a third party. We have some small slivers here around order to liquidation, which just basically means shutting your company down, transferring using an IPO, which is not available to everybody. Your company obviously has to be at a certain size to be able to do that. And then most people in this survey were just unsure of how they're going to do it. So this is what people are generally thinking before they start that planning process of how they're going to transfer. Then this is what actually happens in the real world. So this is from the M&A Source. So the M&A Source is an organization of M&A advisors, and their affiliates, the IBBA, which is an association of business brokers. And so this data comes from deals that actually happened in Q3 of last year. So 2022 Q3. So those that were selling to third parties, kind of external parties, not transferring internally. This is what actually happened for real in the marketplace. So 23% of businesses transferred to individual first-time buyers. So these are people that have never run companies before, never owned companies before, and they purchased a company for the first time. So, it's about 25% of the graph. 26% were transferred to businesses, people that have run businesses before. So these are individuals that maybe they're serial entrepreneurs, or they're running multiple companies at the same time, and they're acquiring more assets, corporate assets. That was 26%. The bulk of the transfer happened here, the 37%, which is existing companies that purchased, bigger companies buying smaller companies, or strategic players in a space that can leverage the business that they're purchasing. That was 37% of the transactions that happened. And then we have some smaller slivers over here. And we had private equity. They were purchasing companies as a platform play. And what that means is when a private equity company enters into a space and they're looking to buy that first company, that will be deemed their platform company. Usually platform companies are a little bit larger. So they're doing kind of $1 million, $2 million in earnings. And the private equity will come in, buy that company, and then they'll bolt smaller companies onto it. So you see that 5% of the transactions that happened in that quarter were platform companies, and 6% were add-on companies or bolt-on companies. And then there's a small sliver here of others. So maybe these were recapitalizations, or maybe they were selling to other partners within the firms, that kind of thing. But this is what happens in the real world. And mostly this presentation, I'm talking about, okay, how are we attracting that strategic buyer? And why would we actually want to attract that strategic buyer? Okay, this is just for your general information, and I found it quite interesting, so I put this slide in. Again, this is Q3 2022, so last year, third quarter. It's the most up-to-date information that we have. This information is released by the M&A Source every quarter, but we haven't got Q4 yet from 2022. So these are deals, businesses that went to market to sell and didn't sell. Is this block right here. So 51% of those deals that went to market were terminated, and then 49% of them closed. So it's as close to 50-50 as you can get. Businesses that went to market that were successful, and businesses that went to market that didn't see success. So part of this presentation is showing you guys how we can ensure that we are successful, whether we're selling to a strategic or otherwise. This is buyer versus seller's market. So what's actually happening out there, or what was happening there in Q3, as far as do the buyers have more control in the transaction, or do the sellers have more control in the transaction? And it's pretty clear that as businesses get larger, so this is the deal size, the purchase price of the company, you start to see as the deals get bigger, the sellers start to have more control in the transactions. And it's like more control in setting price, more control in who they're selling to. And that makes sense, right? Because as companies get bigger, there's less of them. It becomes a scarce resource. It's just the classic economic demand curve, right? You have less supply and more demand as companies get bigger, which pushes the control of the sellers up. This is a question that always gets asked, and it may have been covered earlier in another presentation. How long does it actually take to sell a company? This is actually what happened in real world over Q3 in 2022. So the bulk of companies took about 9 months to transact. Some really quickly, maybe smaller entities that were easier to transact. And then some, look over here, 9% took over 24 months, so over 2 years. So there's no clear answer to this question when I get asked it, but I say to sellers that you want to kind of expect that it's going to take anywhere between 9 and 12 months. It's kind of a good heuristic. All right, so the M&A landscape in general. This is Canadian data, and I know that the presentation we're on today is North America. So if you're in North America or if you're in the US, just know that it overlays completely the exact same as far as percentage wise. But just so I find this data interesting, it's the businesses that are in the Canadian ecosystem that have 1 to 99 employees represent 98% of companies. So pretty much all of them. 100 to 400, like 500 employees, there's 23,000. And then 500 employees plus, there's only 3,000. And I actually have the US numbers here on the next slide, but this is right from StatsCan, and it's just interesting. It's like, all right, as and kind of relays on the other slides have been showing, as companies get larger, there's just less of them, so there's more demand, less supply, pushes prices up, pushes EBITDA up, pushes multiples up. Okay, this slide I'm going to hang around on for a little bit because it's important to understand for all of us that are business owners that are thinking about selling our companies. This is the evolution of businesses. So basically, everyone starts out as a stage 1 company. Stage 1 companies will sell for anywhere from 0 times, which basically means you're shutting the business down, up to a 1 times EBITDA. And EBITDA, for those of you that have never seen it before, is an acronym, but it stands for earnings before interest, tax, depreciation, amortization. I'm going to dive deeper on it on another slide. But for now, just the purposes of this slide, just think of it as earnings. This is the earnings of a business. So stage 1 companies are selling for kind of the 1 times 0 to 1 times earnings. They represent about 90% of the businesses that are in the marketplace at any given time. So in the US, it's about 24 million companies. In Canada, it's 3.8 million companies. Revenues in these businesses are 400 to 500,000. And so their EBITDA, their earnings, these businesses are generating are anywhere between 0 and 100K. So these assets are potentially unsellable. And that's because they have not reached a threshold that will be attractive to a buyer. When you think about small businesses and someone that's going to be acquiring a small business, like who would actually be doing that? And I have the buyer types down here. So you're going to have people that are maybe liquidators, turnaround experts, family, friends, employees, or optimists. So the optimist is usually the individual investor who's going to be an owner operator who's going to step into the shoes of the current owner and then run the business there, like from there moving forward. That's the person you're likely going to be selling to with a stage 1 company. So the exit options that you have at this point are already liquidation of the assets, transfer to a family member, transfer to an employee, shut the business down, or you could build the business a little bit larger and improve sellability and move it into stage 2. So again, this is where every business starts, including every business that I've ever started. They all start here. So it's not a bad place to be. It's just kind of the starting spot. Then stage 2 companies, multiples start to increase. So 1 times to 2.5 times EBITDA is usually what these companies are going to be selling for. This is I want to draw your attention to this. It's like, okay, we go from 90% of businesses in the marketplace down to about 8. So there's already like a big drop off here in companies that make it to this point. So in the US, there's about 1.9 million of these companies. In Canada, there's around 100,000 of them. Revenues are between 500K and 3 million, and EBITDA is between 250K and 750,000. So there's some more options that open up here for people that are thinking about selling. At this stage, you have created a sellable asset, at least from an earnings perspective. I say that the door to the private capital markets, whether you're talking about a strategic buyer or just a general buyer in general, that really opens up around that $250,000 mark. And if you're trying to sell to a strategic $500,000 in earnings, is really where they start paying attention. And so here you can sell to a third party. You can still transfer to family, transfer internally, or you can move the business forward to the next stage. The buyer types you're looking at here: owner operators, individual investors, partners, family, employees, or competitors, suppliers. So your competitors here are your strategics that are looking to acquire because they have some leverage that they can probably increase the value of your company just by bringing it under their hood. From there, stage 3 companies, and this is where the EBITDA start to really move up a little bit, is the multiples. That is 2.5 times to 4 times EBITDA. And by the way, this is across the board. So this isn't industry specific. It's just generally at this size range, this is the multiple that companies will sell for. Big drop here, right? So now we're only dealing with about 2.5% of the marketplace, 700,000 businesses in the US, 34,000 in Canada. Revenues are about 3 million to 10 million. EBITDA is 750K to 3 million. And so, but you start to unlock a couple more buyer options, right? And buyer types. So private equity groups start getting interested here. Financial acquirers start getting interested here. Family funds, search funds, family offices. You're still going to have your competitors that are larger companies that are interested in buying companies of this size. You can sell to your management, you can sell to partners, you can sell to employees, and you can always transfer to family. So these are the buyers that are available for you at stage 3. And then stage 4, again, smaller. It's about 2% of the businesses that make it to this stage in our marketplace. EBITDA is, start to jump again. So you're 4 times to 7 times EBITDA. You've got about 500,000 of these businesses in the US, 23,000 in Canada. Revenues between 10 million and 100 million. EBITDA between 3 million and 10 million. So there's one more option, or a couple more options to get unlocked here. You have the IPOs, so you have the public markets that get interested here, and hedge funds. Other than that, it's the same as stage 3. So our strategics, the ones that are looking to, they have an advantage outside of the regular buyer, and thus can pay a higher multiple and a higher purchase price for your business. They start entering here at the end of stage 2, but they really live in stage 3 and stage 4. So we're trying to get ourselves to those stages. Now, one of the things that, actually, I'll just pull the link for you guys because I know I can put it into the chat. 1 second. I have a guide for this for those that are curious or interested. Here we go. So that link will take you to this guide I'm going to show you. So basically, I just showed you the top half of this, of what we put together for a business owner's sellability checklist. So this top half here is what I just walked you through. But the bottom half of this, which I just put a link there in the chat, this is everything you need to do to move from one stage to the next stage. So if you're running a stage 1 company right now and you're worried that your business is going to be unsellable, which there's a chance that it might be, right? And this isn't a judgment thing. It's like I've had multiple businesses in stage 1 that were unsellable assets. Part of my history is that I used to be a professional wakeboarder, and we built the largest wakeboard facility in North America. And it was a great company, and it ran in the summers, and it was a really good way to, spend my 20s. But it was a good business. We had 25 staff. It was unsellable. And it was unsellable because a lot of these things, if I could go through this list, there was a lot of things that I was not able to check off. And when we went to actually transition this, we couldn't sell it, and it ended up being a liquidation. So I've been through these things myself personally. Is part of the reason why I spend so much time talking to people about how to avoid it. But this sellability chart shows you how to get from stage 1 to stage 2 to stage 3 to stage 4, and exactly what you need to do at each one of those stages to make your business attractive to a strategic partner. So as long as you're checking these boxes off, you'll be able to sell to someone who's a strategic. So that's the link right there if you guys are interested in it. Okay, the next couple of slides are just to basically cement home what I'm talking about here, or drive home, I suppose. So this is actually, again, this is real data, what happened in the marketplace for Q3 of 2022. This is based off of and only from businesses that actually sold. So businesses that sold for under 500K, selling for a 2 times multiple, 500K to 1 million, 3.3, and you just see it goes up. And then at 5 million to 50 million in deal size, so this is the sale price, they were selling for a 5 times multiple. When you actually break out this distribution in the businesses that sold for between 2 million to 5 million, you can see that the multiples are a little bit all over the map, but the bulk of stuff is happening here between that 3.5 to 4 times multiple, or maybe even 4.5 here. Like right, this is the middle. If we actually had a proper bell curve here, you'd see that this was the largest percentage of deals that transacted at this size between 2 and 5 million. We're kind of around that 3 to 4 times multiple mark. If we bump up a little bit more to 5 million to $50 million deals, you'll see that they start at 3.75 times multiple and they end at 10 times multiple. So we're seeing that this is trending up just because of the size of the businesses. Larger businesses are deemed less risky, and they're also more scarce. So because of that, the multiples are a bit higher. This is what happened as far as industry, what was selling, what industries were selling the most in Q3 of 2022. So manufacturing was selling the most, construction and engineering next, and service and personal, and then it kind of goes down a little bit. And I always find this interesting because, this changes every single quarter, but IT was lower. We always think that, there's a lot of trading happening like SaaS companies and technology companies, but the reality is not as much as we think. This is a similar chart that comes from the Axial network. So how do strategic buyers value a business? And this is, pretty much the bulk of this presentation, I suppose, and like what we're here for. We're kind of here to learn what strategics care about. And this is where I think I'm gonna teach you guys about EBITDA for those that don't know, and then I'm gonna deviate a little bit and show you, how you and walk through how you would actually make sure that your business would sell to a strategic. But this is important information to know. So if you're just trying to do a quick back of the napkin valuation on your business, you need to know what your earnings are. Again, like we've used this acronym EBITDA, and I'm going to teach that to you in a second here, what that is. And then you need to know what your multiple is, what the riskiness of your business is to determine what the value is. Because you're going to take your earnings, you're going to multiply it by a multiple, and then you're going to find out what the actual value of your company is. So when we break open what EBITDA actually is, it's interest paid on long-term debt. So it's earnings before interest paid on long-term debt, taxes, depreciation, amortization. So it's actually a really easy number to come up with. All you do is take your P&L, you just look to the bottom, you go, okay, there's the the net income that I made in this particular year, or whatever period you want to look at it, but a year is what you want to look at mostly. So look at last year, and then you just add back your amortization, depreciation, you add back the taxes that you paid, and you add back the interest in the long term that you paid on long-term debt. There you go. Now you have EBITDA. So if you're worried about that number, it's like super easy to calculate. The adjustments, what I have down here, because you also want to think about in your company when you're putting together an EBITDA number, like trying to figure out what the true earnings and the true benefit of a business are. You want to think about adjusting that, because you may be running things through your business that are discretionary spending that a new buyer or a strategic buyer or buyer, any buyer, doesn't need to run through the business. So you maybe have your life insurance running through it. You may be paying a spouse or children through the business, and they aren't necessarily working in the business. If you own a restaurant, you may be running all your personal groceries through the business. If you run a construction company, all your home renos and everything are going through the business. So those are the things you're going to want to extract out, those extraordinary expenses that should not be running through the company. You're going to want to extract those out, and you can add them back on. What else do I? Anything you're doing for tax mitigation and non-business related expenses, you can add back on when you're doing this adjustment. That'll get you to a number that is the true benefit that a buyer, when they purchase your company, the true earning benefit that they're going to get out of your business. So you need to know that. Then once you know that, you need a multiple number. Now, I've given you in this presentation, just getting to this point, the different size ranges of businesses and what the average multiple that things are trading at those size ranges. That's part of the equation. It's not all the equation, it's part of the equation. That's the part which is size, right? So as businesses get larger, the multiples naturally increase. The other factors that you need to consider are the industry that you're in. So each industry basically has its own bucket of multiples, because each industry has a different risk profile. So if I'm looking at a restaurant, it is a much riskier asset than a property management company. Property management company has contracted revenue. They have contracted clients. They know every single month exactly the amount of money that's going to be coming through the door, which makes it very stable for growth and makes it very stable for predicting future earnings. So that industry in general is a low risk industry. If you look at the restaurant, on the other hand, like it can be affected by all sorts of things. It's labor market. You need a lot of staff to operate a restaurant. That can be difficult. Food pricing changing can be difficult. You have the pandemic that got thrown in recently during COVID, and they shut all the restaurants down. So the government decided to do that. So that makes this a higher risk profile industry. So that just reduces multiples, right? So you have your size, and then you have your industry. And lastly, you have your unique company risk. And I'm going to speak to unique company risk in this presentation. This is where I'm going to deviate off of the regular slides and talk to you a little bit about that, because this is a piece in your business that you can actually impact. You can do something here to increase the multiple of your company by reducing the unique company risk that you have in your business. And so either way, these are the big two pieces. You know what your earnings are, you know what your EBITDA is, your adjusted EBITDA. You get a kind of an idea of what the riskiness of your business is, so what multiple is going to get paid for your company. That's going to give you the value. By the way, the easiest number to use to put in here, if you just want the pure back of the napkin, is 3. So if you're like, I don't know exactly what number to use, you can use 3, and that'll get you in the ballpark of what your business is worth. So that's my next slide. Here's an example. So this is data pulled from the telecom industry. So you have, if you know your NICS code and SIC code, you can get this data quite easily. This data, I'll walk you through this very quickly, and then I'll show you the places that you can get it from. So basically what this is showing us is for telecom companies, which trade for a pretty high multiple, because again, it's a low risk industry in that once you've like, yes, we will switch our telecom provider every once in a while, but for the most part, once we've locked in with a telecom, it's a high cost. There's high friction to leaving and going to another provider. So we usually stay with our provider for long periods of time, which means that that revenue is pretty baked in and easily predictable. So when we look at this, there's 51 companies that are in this data set, telecom companies that sold in the last 10 years. The low end, they're doing on the low $1.8 million and the high $74 million. And on average, when you go down the mean, these companies were trading for a 7.3 times multiple. So that kind of gives us a general idea of this industry. It's a little bit higher than average, because average, when we pull this data on most industries, this middle mark will be around 3 or 4. One thing I will note for the Canadians that are in the audience, Canadian companies trade for lower multiples than US companies. That's because getting capital, financing, funding, borrowing money in Canada is substantially harder than borrowing money in the US for businesses. So that reduces it. It makes it more, the cost of capital is just higher. So prices of Canadian businesses are lower. So multiples are lower. So for Canadians that are in the audience, if you're looking at this, reduce the multiples by about 1, and it kind of brings you to what would be happening in Canada. So anyway, this data, like if you're interested in this data for your own company, you can go, I do have our site open. So the Open Road site is here, and it's openroad.io. Actually, maybe I'll just toss this into the chat too. This is a whole bunch of different links, but underneath valuation resources, all of these links take you to different resources that will give you data similar to this. The data that I pulled that from was Business Valuation Resources. BizMiner is another one. PeerComps is another one that I don't have on here. You can get this data also from iBizWorld. But these are places that you can actually capture this data on, like what businesses in your industry are trading for. And all you need to know is your NICS code. So this is what it looks like in real life. If you're using Business Valuation Resources. So the last one that I just did was an employment services company. And so you just go to employment services. There's their NICS code is 56131. There's 259 of these companies that have recently sold. And then you can just look down. And so for this industry, the average EBITDA is 5.6. So again, if you're in Canada, it's more like 4.6. So you can see every industry is a little bit different, right? Just because of risk profile. So that I was going to touch on. And then as far as kind of deviating off course here, one of the things that I was going to show you, I just thought it might make sense to walk through this as far as what people could potentially be looking at from a risk perspective. So if you're if you're trying to think, okay, what can I do to increase the value of my company, reduce the risk, and increase my multiple? I'll just walk through this and I can talk to a couple of these things. But one of the things that you can really do is take that sellability guide that I put the link to. That's the bit.ly link here in the chat. You can download that, and then it gives you everything that you need to do to reduce the riskiness of your business. But basically, these are the things you kind of want to think about. It's like when you're going to market, and this is from a valuation that we did, but it's just easy for me to walk through this, but this is how we think and how strategic buyers think when they're purchasing a company. The first thing they're doing is, going through a listing site or talking to a broker that might have listings, or, they might be part of a network that have people that are selling companies. And by the way, that resources page that I put, the Open Road resources page, it has all the places that, buyers hang out, including buyandsellabusiness.com. So this is what they're looking for, right? Like how is it priced? So if it's priced way out to lunch, no buyer's ever going to be interested, because they know that the seller isn't educated in what their company is worth and is maybe irrational in what they're going to sell the company for. So if you can't, the best way to describe this is like if you have a house that's worth like $1 million, and you see this all the time with realtors, but it's probably worth $1 million and it's listed for 4. It's like nobody's calling about that house. They just aren't. And there's no difference with business sales. So you kind of want to be careful about that. The higher your revenue is, the more attractive it's going to be to the marketplace. If people want businesses that are doing good sales, like they're actually driving revenue through the company, right? People care a lot about profit margin. And so for instance, like this company here did pretty poorly when we looked at it from a profit margin perspective. you are going to be compared to the peers in your industry as far as profit margin goes. There's some industries that average profit margin is 3 to 5%. There's other industries where average profit margin is 65 and 70%. So depending on like what industry you're in, that is going to basically set the bar for what your profit margin should be. And if you're below that by a substantial amount, then they're not going to be interested in your company, especially if they're a strategic buyer. If they're a strategic, believe me, they know what your profit margin should be. And they're looking at it and going, this is below what the average is, which is a very easy way to do an acid test in a business of the efficiency that the business is running at. A good way to know this, by the way, and a super helpful resource. I apologize for those that are in the US because I'm sharing some Canadian information that maybe isn't relevant, but the margins are the same, like the percentages are the same. So if you know your SIC code, you can go to this site right here, which is StatsCan. I don't know if this information is as public in the US, but Canada makes this information public. So it's quite useful. And you can just go, again, employment services was the last thing I was looking at, but you can go to the employment and just put your NICS code into that link that I gave you. And then it'll show you, okay, in Canada, there's 5,000-ish of these companies, and their profit margin in general on the low side is 3.7, on the high is 60, but kind of in the middle is about 20%. So if I'm running a business that's, a staffing or recruiting company and my profit margin is 3, I know that I'm on the low side of things. And if a strategic buyer is looking at me, they're probably looking for something that's 15% plus, right? So it's good information to know about your company to make sure that you don't get kind of knocked out of the race right there. Another thing they look at is, EBITDA. The higher the EBITDA, like I showed you, the more people are going to pay for companies. And mostly people are looking for businesses that have EBITDAs over 250,000 on the low. And again, like I said, if you get to that 500,000 mark, that's where you really like knock the door open to the private capital markets and people start paying attention. $1 million is really like, if you have $1 million, then you're good. You can pretty much sell to anybody. Industry, like I said, different industries have different risk profiles, and some are attractive today and aren't attractive tomorrow. So that's there's cycles to that, but you want to look at that. Location. Oh, there's a question. Would Canadian biz stats be dramatically different than those in the US? No, not for. Thanks, Michael. Not for percent the margins of each of your expense line items. It's going to be the same. And then if you want to really dive deep in that, like iBiz World, going back to like this site right here, iBiz World, it'll cost you, I don't know, around $900, might be $600 to get the report on your industry. It is extremely detailed. And if you're trying to figure out, what are my margins at compared to my competitors, and like really trying to chart a path forward, then I would say it's probably worth the money to spend on an iBiz World report in your industry. But they have US and Canadian data, and they have a lot more US data than they have Canadian data. That's a good question. How do multiples compare at the 1 million mark versus the 300K to 500K mark in the same industry? Yeah. So, I mean, we can look at it like just as an example. Like, so this is what we were looking at, this employment services, right? So we can go and say, all right, so if we're just to do this live. So if we want a company that's got, this is a big data set, so it's actually kind of a nice one to do. So we're looking at EBITDA, and so we want to look at 100,000 in EBITDA, and maybe the top will go up to 500,000. So that's going to give us a data set of 44, right? So our average here in that swath is 3.1, right? So okay, that's information. And then if we change this to what you're saying, so now we want to go 500,000 in EBITDA, 1 million. Now we have 19 again, like as we're getting to bigger companies, there's less of them, right? But our EBITDA on average is 5.5. So it moved by 2, a 2 times multiple. These are companies that actually sold in this industry. So this isn't a question mark. This is actually what happened in the real world. Search Funder has IBIS reports free. Oh, yeah. That I actually, you know what? I knew that. I'm part of Search Funder and I haven't utilized it. Thank you for reminding me of that because I'm in the process right now. It doesn't give you you don't get the full detailed report, but it does give you probably enough. So that's awesome. Thanks for that. Okay, cool. And thanks for using the chat, guys, too. So, and location plays a factor too, right? Like I live in a bumpkin town, and it is uh, companies sell for less here, and there's less buyers because unless you're a skier, there's probably no reason to live here, right? Whereas if you're in a major city center, there's more buyers, it's more attractive, there's more of an employee base, all the rest of it. So that'll drive up the attractiveness of a company to a strategic. So that's like your marketability, but you want to make sure that you're nailing it at this point when you're selling your company, because if you can't hit these criteria, then people will look past your business. I did another session this morning with another group, and this is the whole employment services that I was talking to a group that was that's what is their sector, and one of the guys that's in it, he just put into the chat, oh yeah, that he looked at 100 companies last year and they bought 7. So, or engaged 7. They didn't buy 7, but they got to the LOI stage with 7. But that's like how many companies strategic they're looking at before they actually engage with people. So it's, you want this marketability piece is a big piece. Then people look at operational risk in your business. So how much regulatory oversight is there in your industry? What's your customer concentration? This is a huge one. It's like, okay, if my customer base is like is 3. I was selling a company that was an oil distribution company, and they only sold to CP Rail, which is like the big railway here. We only have 2 railway companies in Canada. It's the biggest. And so if you lost that client, the company is obsolete. It's like Rob Slee says, you're one phone call away from oblivion. So you got customer concentration is a big thing. If you have one customer that's over 10% of your business, you want to rectify that. Supplier dependence. If you have, supply issues, then you want to have redundancy with your suppliers. This is the biggest one with small companies. So those companies that are in that stage 1 and stage 2 that I showed you earlier, they're very owner dependent. It's just the reality of them. Here's the hack and the trick to selling. What you want to do and what we do with our clients is like when we meet with a business owner and they're in that stage 1, stage 2 size, just take your key person, the best person, the best employee you have in your business, promote them, make them the general manager, and do that before you take your company to market, because then it immediately it starts to alleviate that owner dependency issue because there's a general manager in your business. We've done this multiple times to get through this barrier with strategics. This company obviously had an issue with that, had an issue with key person dependency as well. It obviously had a good lease. If you have a lease and the lease only has a year or 2 years left on it, there's a high probable chance that your company is unsellable, because whoever's acquiring your company, they are likely going to go get financing. The bank will only lend up to the term of the lease, because the bank's going to, you have 5 years in your lease with a 5-year renewal, they can do a 10-year loan. If you have a 5-year and then it ends, they can lend for 5 years. If you have a 2-year, they can only lend for 2 years, and that's going to make the monthly payments way too high. Policy, I was going to say 7% purchase is pretty high, eh? I don't know what that one was for. Sorry, Paul. Facility, like you want a good facility, obviously. You want mission value cultures, like culture built into your business. If it's a strategic, they'll usually be looking for, actually, if they've acquired multiple companies, if it's someone that's never acquired a company before and they just started their PE fund, they may not be looking into mission, values, and culture. But if they've acquired multiple businesses, they will be looking at that, because they're trying to determine the platform company that we bought, we're rolling these other businesses into it, is that they're going to be a cultural fit? Because sometimes that'll implode an acquisition if there's not a cultural fit, because you'll lose all the staff. Financial controls and reporting need to be in good shape, and your legal needs to be in good shape. And that's what they'll be looking at for operational. As far as growth, strategics, what do they want to do? They want to buy companies for certain multiples, and they want to grow that business so they're worth more. Paul asks, how important is culture? In my view, I've heard it's the main reason larger deals fail when they fail. So I did my MBA through the Jack Welch Management Institute, and if you were at a certain point in your class, you got to have a call with Jack Welch, and Jack did, and he's passed away now, as people know, but there was a year when GE was growing and they acquired 300 companies in 1 year, which is like mind-boggling to me. Anyhow, and I asked him, like, what was the big thing that he learned from that? And he said that the biggest thing they learned from it was that the ones that they acquired that didn't have a similar culture alignment always failed. So they learned that in the process of acquiring that many businesses. But in reality, most of the buyers we work with, it's about 50-50, actually. About 50% of the buyers don't care and don't look into it, and 50% of the buyers do care and do look into it. So for us, it becomes an important thing to look at in a business to make sure that they've at least tried to nurture and build culture, because if you don't have that and you haven't done that work, you're potentially losing out on 50% of the buyer pool. So that's the best way that I can answer that. So this is what the people are looking at from a growth perspective. They want to know financial trends of the business. Is it going up? Is the financial reporting done well? I can't underestimate, or I can't understate how important this is. Like, you need to have good financials. You just need to have good financials. And if your financials aren't clean, just clean them up. It's not that much work. It's not work that you need to do anyway. Your accountant does the work. Hire somebody to do it. But just make sure it's done, especially if you're trying to sell to strategic. This will kill you in diligence 100% of the time. They're going to look at your value proposition. So like, how much can you make per customer kind of thing? Is the business set up for scale? If it isn't, not the end of the world, because a lot of strategic are going to have done that work and they're going to bullet you on, and then they're just going to use their systems and processes. If it's somebody that it's the first company they're acquiring. So if you're at the kind of $1 million to $2 million EBITDA range, super important to be set up that way, because then you can be acquired as a platform company because they'll be looking at your systems and processes, and all the other businesses they're going to be bolting on, they're going to be using your systems and processes. Sorry. Are the management and staff in a good spot? Do you have good quality staff and management, and all your systems and processes up to snuff? So they look at this because that's what they look at to determine the ability to grow. As far as capital risk, what's your working capital requirements? Here's an example of a company that yesterday, I was probably too candid on the phone, but it's a flooring company. The flooring company does like $200,000 a year in EBITDA, and they have $2 million worth of inventory. This is an unsellable company, the way it's structured right there, because, well, I have inventory down here, but if you're not managing your inventory properly, the buyer's going to come in, they'll look at the business and they'll go, okay, fine. You've got like some obsolete inventory. You've got, twice or three times the inventory that you actually need. It's like, we're not buying this inventory when we're buying this company, right? So it's, this is all how you're managing your balance sheet, basically. So it's like, just make sure that you're managing your balance sheet properly. Keep your working capital as low as possible, meaning that you collect on your receivables as quickly as you can, and you can extend your payables a little bit further out. That will reduce the amount of working capital your company needs. Every single deal that we do, every single deal gets hung up for a portion of time negotiating working capital. And there's always a working capital calculation, and the sellers always say, my company needs $50,000 to operate it. And the buyers are always like, no, it needs 200K. And it ends up being this negotiation piece around how much working capital is going to come with the business. Capital structure, debt levels. So, it's natural that businesses have debt. So it's not the end of the world to have debt, but you just want to make sure that's not out of control, because if it's out of control, it may make your company unsellable. Because why is it out of control? Like, why have you not been able to service your debt over a period of time? I already talked about inventory. And then sales cycle is basically the time that it takes for you to collect off your client. And, you want that to be as short as possible. So, okay. So they look at that. And I know I only have 5 minutes left here, but I'll be able to get through these last few ones. Deal term risk, this is what we're talking about. So basically, if you are really fixed and really rigid about the terms of how you want to sell your business. So basically what I'm saying here is like, I'll only accept cash offers, and it has to be full offer price. It's like, sorry, you're not going to, you may not sell your company. That's like super high risk. It's like, because terms are always happening with deals. There's going to be an offer price. It's going to have a structure to it. It's going to be, there might be some vendor note. There might be an earnout associated with it. There might be, you might get stock in the parent company. So if you're willing to accept those terms and you're willing to negotiate around those terms, you can usually push your purchase price up because you can change the terms of the way that the capital stack structured kind of thing. Multiple decision makers. If you have like 4 or 5 or 6 shareholders in your business, that becomes difficult to sell to a strategic because they just don't want the headache. So it almost suggests like buying a few of your partners out before going to market. Training and transition plan. If that's in place, it makes it easier. If you know what you want, it certainly makes it easier. If your business is, has good cash flow and is financeable, that's helps out, and certainly helps out with selling and reduces the deal term risk, and your commitment to sell. This happens way too much. And like for us, we actually screen for it in the beginning of our process. Some people want to sell their company, but not really. Like they just don't know what they're going to do afterwards. So they get close. I have a client I've been working with for almost 4 years, and we've had maybe 15 offers on their company. But every time they get something like, oh, maybe we aren't quite ready to sell, and there's back and forth and back and forth and back and forth. That commitment to sell is like you may not sell to a strategic because they just don't have time for it. So you kind of want you need to know what you want, but more importantly, you need to know what you're doing after you sell your business, and then it makes it easy to transition. Nunzia says no rush. If you can take it to 355, yeah, that's fine. No, I can certainly take it to that. I can go on. Okay. So then this is benchmark risk. So basically I highly recommend doing this work. And it's very simple. It's not difficult work. You just go to iBiz World or you become part of Search Funder, and Search Funder's free. And then you can get an iBiz report on your company. And from there, you'll know exactly what the ratios are in your business. So gross profit margins, operating profit margins, general profit margin, SD, EBITDA margin, like all of these things you'll know. Return on equity, what you're supposed to make in your company, return on assets, inventory turnover, current asset ratio, all this stuff, right? And then what you can do is you can say, okay, now I know what I'm supposed to be doing in my company. What am I actually doing in my company? And then you can just compare it, right? And this is how this company fared when we did this work for them. And for the most part, actually, they did pretty well. Like they're doing poorly on turning over inventory, but other than that, like they're actually not doing too bad in their industry. So they got a grade here of 73%. I don't see this that often. Like usually people are a little bit weaker if they haven't thought about it yet and haven't looked into this stuff. So yeah, so have a look at this, because your strategic buyer is 100% going to be looking at this, because they're going to be comparing your industry or your business to the ones they've already acquired, right? So, so that's it. I think for this this was completely off the rails from what I would normally do in a presentation, but I thought this would be helpful for this one. Andrew said, this is great. Can you share this link, the valuation example? I don't have this in a link. What I could do, just take a screenshot of it. I'll just cruise through them and then just take a screenshot of these. So this is marketability. This is operational. This is your growth risk. Capital risk. Deal term risk. And benchmark risk. Okay, hopefully that helped. Paul says, to your last point, have you seen any 60-40 deals in larger transactions? Buyer purchased 60% up front and seller keeps 40% equity or earnout. Then the seller stays in, directs the operations, and doesn't immediately retire. Yep, 100%. Yeah, for sure. We've certainly seen that. And I don't think it's a bad idea if the nice way to do that actually is if you don't want to exit today. Like say I'm finding this now. It's like say you're 65, but you want to exit when you're 68. Then you can bring in a strategic partner that it's called recapitalization. But just like you said, like they'll buy 60% of your company, they'll leave with 40%. But if you can get someone that works in that industry, knows your industry, and has leverage that they can scale your company, you'll be able to make almost the same amount when you sell the 60% as in 3 years when you sell the 40%, because you can basically pair up with them if your timing and their timing aligns. It's a private equity firm that has a fund that has to be exited in 5 years, and you can enter with them on year one, sell 60% on year one of your business, and then grow with them over those 5 years, and then exit with them on year 5. That is an awesome way to make a ton of money. because you make your 60%, you take some of your cash off the table, and then now you're with this rocket ship that has the capital they can infuse into your business, but they also have the expertise to scale it and the network to scale it. And then that 40% when you sell it it's worth much more than the 60% when you sold it like 5 years previous, right? So that's a good one. Oh yeah, okay, yeah, awesome. Anunzio is going to share all the recorded sessions, so this will be available to kind of go through and snag from. So that's awesome. Okay, so I'll go back to our regular programming. So this is what I was showing you. It's important to know your NICS code. When you know your NICS code, you can kind of capture all this data. Oh, this is actually, I got to click back out of the presentation again. This is to help you guys kind of get your heads around like what a strategic buyer does when they're actually looking at your company. This is what they do. So this again, I was doing this morning, this staffing company, right? But let's assume your company has $5 million in revenue. It's got EBITDA of $875,000. So a monthly EBITDA is $72,000. Like that's what's available in the business. So somebody who's coming in and buying this company, they're going to have to determine what multiple am I going to pay for this business. And again, they're going to look at the industry, they're going to look at the size of the company, and then they're going to look at the unique company risk, which I just took you through, to come up with a multiple, right? But let's say, okay, they decide that they're going to put a 4 times multiple offer in. That's $3.5 million for this particular company, right? So then they're going to structure the deal in a certain way that's going to fit their criteria and the hurdle rates that they have and the return that they're looking for on this particular investment. So I walked through a few of these here. I'm not going to dive like super deep, but I just want to kind of get it across so you can kind of get a general understanding of like what people do in this situation. So a traditional way of acquiring this company could be 30% down. So the buyer comes with 30% and 70% bank financing, right? And as we all know, the interest rates are going up. So this is affecting and dropping the prices of the business they're selling for. But this is a way that they could purchase it, right? And then so for the buyer, when they're looking at this is their deposit, this is the loan they're going to be taking out. The cash at close to the seller is going to be the 3.5 million, and the monthly carry for them is $30,000. So what it looks like at this multiple is that they're going to be getting a 48% return on their investment, and their cap rate's 25%. So if we're on the sell side and we know this information, and we also know that maybe the return on their investment that they're looking for is 30%, we know that they can actually pay a little bit more. So maybe they can pay a 4.5 multiple. They're still getting 39, right? So they could maybe pay a 5 times multiple. So this is why it's important to kind of know the information, the moving pieces, because you might be able to negotiate and push your multiple up a little bit more. Another way they could do is all cash. So if it's all cash at a 5 times multiple, it just looks like a 20% return. Another way they could do it is putting in some stock. So there's a stock rollover. So you've got 30% down. They're doing financing 50% of the purchase price, and then 20% of the purchase price they're giving stock in the parent company to the seller. So this is assuming that a strategic buyer is acquiring that has a larger company that's acquiring a smaller company. Then to them, this looks like a return on investment of 41%, and free cash flow per year is 549,000. In this situation, it's 875, and in this situation, it's 419. So things change depending on terms substantially for both parties, right? So a lot of these pieces get moved around during negotiation of a deal, and it's all still the same multiple, right? So I just kind of want to expose that to you. This template you can't guess. Sorry. This one took me like weeks to build out, and I'm constantly modifying it, but it's mostly for like our clients, just kind of walking through scenarios. But yeah, so showing you that, and then as we're kind of winding down the clock here, one of the things that I add, yeah, Nunzio says IP. Yeah, for sure. Yeah, so this right here, I add these slides in just to showcase to people where we can add value, right, in the sales process. Yeah, Paul says he was one that took a month. They take a while to build these things. Yeah, so what I want to show here was there's a certain points in time when you're going to sell your company that you can add value to it. And whether you're selling to a strategic or you're selling to anybody, it's all good. It doesn't matter. It's like these are the points where you can add value. Get a business valuation. Actually, starting here, understand what you want. Like that's the biggest thing. It's like understand what you want when you're selling your company. It's hard. When we sold one of our companies, I cared a bit about what we made, but I cared more about just the time for getting rid of it. So I had free time. I was about to get married. I wanted to travel before I had kids, and I needed to get rid of this company. So I had complete freedom. That was my goal at that point. So as long as you know your goal, then you can do a better job of targeting it. But that's kind of beside the point as far as adding specific value. Getting a good business valuation. I know Roxanne is on this call. Like, you can use Roxanne, but getting a good business valuation is like incredibly important because it'll show you the weak points of your company. You'll learn what your actual EBITDA is, and that'll help in pushing the price up to a potential buyer, because now you can use that number versus what your accounting number was. This I can't understate how important this is. The other thing that's really important is doing a pre-diligence audit on your business. So basically taking your business through an exercise that a strategic or just any other buyer would be going through when they're acquiring your business. I showed you that slide right at the get-go. It's like 50% don't make it, and most of that's because they don't make it through diligence. So do a pre-diligence. That'll help you increase the value of your company, or at least at minimum, it's going to help you avoid failure. So that's a good spot to add value. Having the right people in your team, specifically a transactional attorney and a good accountant, like they're worth their weight for sure, whatever they charge. That'll help you add value, make more money. All the stuff that you learn in your valuation, the weaknesses of your business, you can use, de-risk your business and do value enhancement there to push up your multiple, reduce your risk. That's where you can add some value. A big part of adding value in a sale is identifying multiple buyers. So you can have, if you have one buyer, you got one buyer. If you got 10 buyers, now you have a bit of a competition going, right? You want that. So buyer identification is a big thing. Buyer offer negotiation. This is a big piece. So during the negotiation, you can obviously push your price up if you're a good negotiator. And then phase 5 is all about just retention of price. So after an LOI or an offer signed, then at this point, it's called retrading. Like, you might have a buyer that put an offer in, and then as they go through the diligence process, they realize the business is riskier than they anticipated. So they try and erode your price and drop your price and retrade. Phase 5, you can just try and maintain price. That's what it's all about, maintain that purchase price. So these are kind of the spots where you could add a little bit of value as you go to the finish line. And then, just as we're kind of coming up on the clock here, I'll leave some time for questions, but what to expect in due diligence. I hate when deals die in due diligence, especially from, multiple levels. I hate this. It's like everyone gets excited at the LOI stage. If you're a seller and you get an LOI signed, I can guarantee you'll feel at that moment like you sold your company, and you'll kind of maybe crack a beer. Your company is not sold at that point. When we run through a deal in our process, when an LOI is signed, the probability that we've assigned to it at that point is 50%. So LOI is signed, it's 50% chance that it closes at that point. Like, that's just how we run our metrics. And maybe it's a little bit higher, but that's kind of what we peg it to, because diligence is a difficult thing to get through, right? Especially as your company gets bigger and you get into the kind of stage 2, stage 3, stage 4 businesses. The diligence process can be a ruthless beast. Buyers hire specific companies just to do diligence. They hire financial firms to do quality of earnings reports. They hire legal firms that are just specialized in diligence. Like, it can be heavy. But these are the things that you can expect. Like, I lightly touch on this because there's so much in here. And again, like, running a pre-diligence exercise is super important to kind of eke all these things out. But you're going to have a financial part of your diligence, you're going to have a legal part of your diligence, and you're going to have operational. The financial is the accountants that are doing this work, or firms that are hired to do quality of earnings reports. The legal is going to be firms that are hired to do this work, or it's going to be the lawyer that's working in the buy side team that's going to be going through this stuff. So just make sure all your contracts are up to date. Anything that is legal related should be up to date. And then operational, the buyers care about the operational side. So that download that I gave you guys, that kind of is your sellability checklist. Just make sure that all that stuff, just go through the checklist and just make sure, depending on the size, the stage of your company, if you're a stage 2 company, go down the stage 2 checklist, because that's what your buyer is going to be looking at from an operational standpoint. And the buyers are the ones that decide if they walk or not, right? Like, not the accountants and not the lawyers. And the buyers care most about the operational stuff. Okay, perfect. That takes us to kind of the end and into the next session here. So I can hang around a little bit for those that have questions, but thanks again for attending, and thanks for being part of the Boss Up conference. Really excited to have everybody here and excited to be able to present. And thanks again, Nunzio, for putting this on. Yeah, any other questions? I'll hang around just before the next session starts in 5 minutes. Thanks, Matt. Thanks, Jessica. Thanks, Paul. Thanks, Ian. Yeah, no problems. What was the lower bid calculating on the sheet, Scott? Capital something. Paul, do you mean on the offer comparison sheet? This one? Yeah. Yeah, like when we build this thing out, I'm just looking at, what's getting put down deposit, loans, and what's terms, right? So that, I mean, the whole bottom of this sheet is kind of breaks all these pieces down, like a senior debt, junior debt, vendor note, like all the rest of it. But then it just consolidates it in this one little thing because I'm mostly just looking at, how much if I'm a buyer, how much free cash flow am I generating per year out of this deal after servicing my debt, right? Obviously, if it's an all cash offer and they're not borrowing anything, they're going to have a lot more cash flow. I don't know if that answers your question. Matt says, "Do I work in the U.S.?" Sometimes we do. We've done deals in the U.S. It's not a market that we target, but if people are looking to have help, we'll for sure we'll work with you. Like there's no issues there. Uh, yeah. That's Paul. It's like that's why it took 2 weeks. Yeah, it's like there's a lot more down here. I built this out because we had a buyer that, or we were working with doing a buy side engagement, and we were just trying to structure a deal so that it would satisfy the seller's needs, but also get a return that was going to satisfy their needs. So I built this out because we were just working on a whole different different ways of structuring the transaction. I guess I can probably stop sharing this. There we go. Okay, awesome. Yeah, well, if there's no other questions, thanks again for attending the session. Much appreciated. And we'll see you guys in the next session or in the networking area. Awesome. Thanks again.